Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Apple Incorporated, ticker AAPL. Over the next 5 minutes, I'll discuss both the business quality and business valuation for Apple stock. So let's dive right on in. We are using quickfs.net to get this data. Here we have market cap of $2.8 trillion, industry, technology, hardware, storage, and peripherals. Now, of course, these are meant to be as first look companies, but I know Apple, so it's going to be really hard not to know them. This is the company that makes the iPhone, the Mac, the Apple Watch, Beats headphones, HomePods, iPod, AirPods. So these are consumer hardware devices, and they also have a big line of services you can subscribe to, whether that's Apple TV Plus, Apple Music, and using their app store, they take fees for having apps sold. The beta and the share turnover don't really tell us much, as they're a large S&P 500 company. But when we get to return on invested capital, we can immediately see something. So over the last 20 years, there's 20 years of no losses. That's a very positive sign for a high-quality company. In addition, you can see a fairly steady growth in return on invested capital over time. So despite in 2002, they had some struggles. Starting in 2005, you had double-digit return on invested capital. Not just double digits, but in the 20%. So it goes 20%, 21, 22, 28, 33, 30, 35, 41, 42. Dips back to 28 in 2013 and down to 20% in 2017. But every year since 2005, return on invested capital has exceeded 20%, and in 2021 it was 51%. This is an exceptional record on return on invested capital, and it's very attractive for shareholders. Not only the fact that it's above 20%, but also that you have had periods where it's increasing. In order to increase the return on invested capital for the whole company to year over year, they have to actually be earning incremental returns on capital substantially higher than 50% in order to achieve those returns. So let's look at these 10-year median returns. Return on assets, 17%. Return on equity, 44%. Return on invested capital, 28%. Beautiful, amazing numbers. Very high quality. 10-year. So now we need to use the valuation and the 10-year K to get an idea of what this company might be worth. Now, the PE at 27.9 is very, very high. So again, we're seeing everything for a high-quality company, but a PE of 27.9 means that you're certainly paying up for quality. Now, what do you need to justify a high valuation? You need more than just a high-quality company. You also need growth. So they've had revenue growth of about 12.9%, and that's grown faster than assets, which is why you're seeing earnings per share grow even faster at 19%, and why you're having increasing returns on invested capital. That operating leverage is driving the massive returns. Now, if you could sustain another decade of 19% earnings per share, then you could justify something like a PE of 28. The problem is can you actually get 20% earnings per share growth over the next 10, 15 years? That would be difficult. It's not something I would plan on, whether with Apple or with any company. So to me, the valuation looks high. I've bought Apple in the past at PEs of 10 and PEs of 15, and that's turned out very profitable. I like Apple as a company. They're incredibly high quality. But to me, the valuation is building in high growth. If you don't get the growth, then you're not going to get the returns you need. If you get the growth, then you will get returns, but your returns are going to be lower than the actual growth. So if you grow at 19%, your returns might be 10% or 15%. But if you grow at 15%, your returns might be 5 to 10%. So it matters what those numbers are and how long they last. You've seen revenue go from 156 billion to 365 billion. Very good. But the incredible piece here is you're having gross margins in the 38 for 40%, but your operating margins are astronomical in the 25 to 30% range. That's very, very good. You can see a massive jump in 2021, such that the earnings per share went up 71% to $5.61. So they've 5x their earnings over the last decade, which is amazing. And you can see just consistently strong returns on assets. Now, this price to book of 39 would normally be concerning, but I'm pretty sure that's due to buybacks. And we can see that by going to income statement. We should see the shares declining over time. Yes, you've gone from 26 billion shares outstanding down to 16.7 billion shares outstanding. So they've been buying back stock over time. And I think you can see that if we go to the cash flow statement, you'll see that they have had negative net issuance of common stock, which means they're paying large amounts of money into those buybacks each and every year. Looking at $81 billion in buybacks over the last year, $84 billion during 2021, $71 billion in 2022. So they're putting massive amounts of cash into buybacks. Something on the range of like 80% of their cash flow from operations. So that tells you a lot about what you're going to get as a shareholder. You're going to get a lot of buybacks. They are still paying a dividend, which is where a lot of the incremental cash is going. And they have been growing debt, it looks like. Let's see if they've leveraged up. Let's look at the balance sheet. So long-term debt has grown from about 17 billion in 2013 to 109 billion in 2021. They also have kind of they have a lot of cash in short-term investments as well. So it's not necessarily $100 billion in net debt. They have a lot of cash and short-term investments that offset that. So they have a pretty balanced, strong balance sheet that you like to see, especially when you compare that 100 billion in long-term debt to the income statement, which has a net income of 100 billion. So you're in a very good situation there that's well protected for you as a shareholder. So I like what I see here. I believe Apple is probably the best company in terms of quality in the entire world. It's relatively easy to have high margins. It's relatively easy to have high volume. It's extremely difficult to have high volume products that also have high margins. To have an operating margin in the 30% range is astronomically good. To have returns on capital of 20% plus, returns on equity of over 40%, and then sustaining growth with those numbers is incredibly good. So this company is amazing. It should be on your watch list if you like high quality companies. The only thing I would caution is there have been times in the past where Apple's price to earnings ratio has gotten cheaper. Just in the last 3 to 5 years, it's been cheaper. So, consider that there might be better entry points. There's always a period of time where people start to think that the growth isn't going to continue. Sometimes taking advantage of lower prices might be valuable. But I like Apple. I think it's probably the best company in the world that I've ever reviewed. And I like buying it when the PE is 10 to 15. I don't know if we'll hit it again. But if they can sustain the growth rates they've had over the last 10 years, then the current price could be justified. Thank you for listening. If you like this video, hit the like button and also subscribe to my channel. And if you hit that notification bell, then you'll get notifications as I upload new videos like this in the future. Thank you for listening. Until next time, stop paying fees, start building wealth.